afternoon, everyone, and welcome to Stock Market Today for April 3rd. It's Alissa Coram here, and stocks got rocked today with big declines, their worst in several years, as stocks reacted to the tariff news, sort of a worst case scenario, definitely worse than feared. So, a lot of sellers in the market right now. And here to break down all of the market action with me today is my colleague Ken Shreve. Ken, what do you have for us?
We thought a nice layer of uncertainty was going to be taken away from the market when we got the details of these tariffs, late Wednesday. But in reality, it just has kind of unleashed a whole new wave of all
Yeah.
different kinds of uncertainty.
Mhm.
So stocks had a hard time with it today. Wanted to take a look to start with Quest Diagnostics, DGX. A lot of uh, interesting names here. Chubb in the insurance space, ticker CB, and finally healthcare, kind of finding some outperformance lately. So
Yeah.
let's take a look at Encompass Health,
Okay. Well,
EHC.
all right. We'll take a look at those stocks, but first, let's give a diagnostics check on the market here. So first, taking do we still have a pulse? Do we still have a pulse? Because it's pretty brutal out there. Ken, the Nasdaq down 6% on the day. The S&P 500 down 4.8% by sessions close, plunging below 5,400, and the Dow also down sharply on the day by about 4%. Now standing around 40,500. The Russell 2000 got absolutely obliterated today, Ken, with small caps down 6.4% on the day. So no matter where you looked, it was pretty much a sea of red, maybe some bright spots underneath the surface. We'll talk about that as well. But speaking of waves here, we are definitely in this second wave down here in what's been a pretty brutal couple of months.
Yeah, and we had a nice shakeout in the market earlier this week on Monday, and had a nice slightly lower close, but a close up near highs Monday, and then 2 days of closes near highs, and stocks were making a case for a bottom, but just a good lesson on why you don't want to pay attention to the first few days of a rally attempt, because there's usually some short covering. Wait for the short covering to run its course, and then you get a better idea if the market is ready to run higher or not. So we never got that signal. We probably saw some short covering Monday, Tuesday, and Wednesday, but today, yeah, all the lows were taken out. There was some thinking that maybe, hey, 4 days in a row, maybe we'll close off lows and
Right.
we'll see buyers come in and offer support, but that did not happen, and just a decidedly negative close. And some bright spots out there. The same leading stocks are leading here, but just a very treacherous
Mhm.
environment. I think at its low today, the Nasdaq was just talking about this with Dave Chung. I think the Nasdaq got about 18% off its recent high. So definitely an intermediate term correction here, not a full blown correction yet. 20% will be our benchmark there. So Nasdaq came down about 18%, maybe a little more than that off its high today.
Yeah. We are definitely on track for our worst weekly close in quite a while, Ken. Intra week, we are down to levels that we saw last August. So we'll have to see, where we end up closing this week. But it does feel like for now a stay away market. And it was a good thing that we didn't get that sign of institutional buying right ahead of this tariff event. Honestly, I think even if we did, we would have handled it with some caution, just given how big of a risk event this was with the tariffs and how uh widespread. It's not like it was just China or just Mexico and Canada. This was a very broad trade change here that we saw last night after the close here. So a lot of sellers out there heading into it, even though, hey, a couple of upside reversals in the S&P 500, even with 3 up days in a row to kick off the week, still in a weak position below that 200-day line. So, definitely heading into today wasn't a time to be aggressively making big bets. So, hopefully traders are mostly on the sideline, or even today if you needed to cut some losses, hopefully there was an opportunity to do that as well.
Yeah, we were documenting in the big picture during that harsh 3 week decline. I mean, we were seeing unequivocal signs of institutional selling, not only on the NYSE but on the Nasdaq as well. So to some extent, the handwriting was on the wall. So we were
Right.
very defensive. We had lowered our invested percentage, but we've seen when you see really ugly distributions start to build in the market, it often is it just flags
Takes a while.
additional
Yeah.
weakness. So I mean, the good news, if there's any, is that a lot of sellers are getting shaken out of this market pretty quickly. Again, we had obviously a very large shakeout during that 3 week decline, but just recently, I said it was a big shakeout on Monday, and then certainly a shakeout today when that low gets undercut, and the 5400 level can't even hold. So institutional selling, when funds start taking profits in stocks in spades, which is what we've been seeing, it takes a little time to recover from. So and we saw that after 3 straight gains for the S&P 500. Obviously, those were very short-lived after today.
hmm So, fresh lows in this downtrend for the S&P 500 as well here, as we are still modeling 2018 and 2022 as two potential precedents with
Hmm.
three waves down. So that's a potential scenario that we could see as well, even if stocks do end up finding their footing here in the
A lot
short
of
term.
your yeah, a lot of your AI stocks obviously are in the Nasdaq, so not surprising to see the Nasdaq, some 18% off its high now. S&P 500, uh, even though it looks like a very sharp decline, it at its low today was about 12, maybe a little over 12% off its recent high. It looks worse than that, but when you have damage like this done to the stock market, it's the stock market's way of saying it's worried about the economy, it's worried about corporate earnings, it's worried what these tariffs, if tariffs are going to just keep inflation stubbornly high for a period of time. Um, and then what's that going to do to the economy? What's it going to do to consumer spending?
Yeah.
Is it going to cause a sharper than expected slowdown? And then when you have all this economic noise, this is not a great environment for corporate earnings either. So here we are right at the end of the first quarter, and the company is going to be coming out with earnings starting not this coming week, but the following week. We'll start to see some financial reports. Actually, we'll see some financials late next week, but lots of uncertainty there too about what these companies are going to say. Even if they report good results, they're probably going to be talking about economic uncertainty and tariff uncertainty. So, uncertainty is just not
Mhm.
not good for the stock market, and we kind of have it in spades right now.
Right. Okay, Ken, quick thoughts on blue chips and small caps. So, starting with the Dow, your thoughts.
Well, one of the best performing ETFs today was consumer staples, and you have a lot of consumer staples stocks in the Dow. So this is an index that technically does not look much better than the Nasdaq or the S&P 500, but it is filled with a lot of consumer staple type names. So you're seeing some names in the Dow holding up okay, but again, and this was the best performing S&P 500
Mhm.
ETF today. The consumer staples up 0.8%, but
Yeah.
most of all the other sectors were decidedly lower.
Yeah. Quick check on the likes of Coca-Cola breaking
Hmm.
out today, Johnson and
Uh,
Johnson. Those are some
yeah,
some of your go-to type
staples. Yep.
safety type trades there. Okay, let's also quickly take a look at small caps here, Ken. What a brutal day.
Yeah, maybe the area of the market most vulnerable to an economic slowdown, where you could see some of the biggest earnings damage. So Russell 2000 is in a full-blown correction here. This one came down 22% off its high. from today's low. So you can see the IWM was down 5.4% today. So small caps faring the worst here. Not surprising,
Mhm.
but all of these, all four indexes that we just looked at had big undercuts today.
Yeah,
So there's something to be said for sellers getting shaken out of the market, but until this uncertainty alleviates about what
right.
the economy is going to do in the second half of the year, or maybe early in 2026, we're just going to have to resolve that.
Right. The good thing here is that we do know that even if you do have a brutal correction or a bear market, strength always comes afterwards. So now is not the time to tune out. It's the time to look for that strength underneath the surface and be ready for that turn. Maybe traders out there back in late 2022, early 2023 don't feel like they got involved early enough, but now is the time to change that for this cycle, right? To stay engaged so that way you can really take advantage of a market turn incrementally, but you'll be there because you're ready.
Yeah, absolutely, and we're still early. We're still in the early stages of a pullback, even though it's been a swift and severe. Again, utilities and real estate investment trusts and gold stocks are not typically the stuff of new bull markets. So
Mhm.
when we do get a turn in sentiment, I suspect some of these leaders right now are gonna cool off,
Yeah,
and then you're gonna see kind of a new crop of leaders come into focus, and these are the stocks that have been sort of consolidating, taking a breather. So
right.
we've recognized a lot of market bottoms in the past. We know what they look like, and we know which ones have the best chance of working. So we'll wait for these scenarios to play out. But until then, just
Mhm.
makes sense. Just kind of sitting, watching from the sidelines in cash.
Right. Yeah, because you can outperform being in cash
Oh yeah.
depending on the market. Okay, let's take a look at a few more ETFs real quick here. XLE, really tough day for the energy sector. Ken, what happened here?
Just amazing. I mean, this is about the economy too. I mean, it was a nice move off lows for XLE from 84, came up, all ran up all the way close to that 95 level. But this was the worst performing sector, and this is about the economy, not only
Mhm.
demand from China, but just worldwide demand for oil. If we are headed into a slowdown, you would expect oil demand to soften. So that appears to be what was at work here today.
Right. Okay. And then XLY, this is the consumer discretionary ETF. This one down 6% on the day. You have heavy weightings from Tesla and Amazon in here.
Yeah, yeah. So your consumer staples outperforming, and one of the worst performing sectors, your consumer discretionary. Not a real surprise there, but this one looks like it's undercutting some recent lows as well. So maybe some shakeout happening here too. So like to just keep track of what ETFs are leading and lagging on any given day. Seeing a lot of damage among most ETFs, but certainly the staples. Held up well today, and even the utilities, the XLU that you pulled up, even the utilities, which there were a lot of nice movers today, but even the utilities couldn't hang on here. They
Mhm.
tried to cross the 80 level and reversed lower,
Right.
so maybe not such a safe haven today.
Exactly. Okay, and then let's quickly check in on the 10-year Treasury yield before we get to those stocks. A notable decline here today, intraday, almost touching that 4% level. So these are the lowest levels that we've seen, Ken, for the 10-year in a number of months. Going back to mid October last year.
Yeah, so the bond market, there's just been this bond buying that caused the yields to plunge today. So the bond buying is a kind of a flight to safety trade, and you tend to see that when there are concerns about the health of the U.S. economy. So came down to a very key level today, right at that 4% level. I think it hit a low exactly of 4 point, right around 4 point. 0%. So closed off its low. So maybe that's going to be a near-term bottom for the yield. Can tell you right now, the market would not mind at this point to see this yield start creeping higher a little bit. It doesn't want to be continually reminded about the potential for weakness in the U.S. economy. So some rising bond yields, maybe they come off that 4% level, and who knows, could fuel a rally. We'll see.
Okay. Well, let's check out DGX. This is Quest Diagnostics. And the medical services group that this is in is range number 8 out of the 197 groups that we track. So definitely showing a lot of strength heading into today's session. Shares today up 1.6%. And this is a stock that's been trending higher over the last couple of months, pulled back in an orderly fashion, Ken. So it's acting exceedingly well here in a tough environment.
Yeah, it got pulled off highs a little bit. Nice heavy volume gain. It had a nice heavy volume gain earlier in the week too, when it was initially finding support. So again, healthcare, specifically medical services. This is a big, as its name would indicate, a big diagnostics testing company. So again, a safe haven trade, very steady demand for this company's medical services, good, fairly consistent track record of growth, and kind of holding support right at the 10-week moving average here. So you can see where money is parking in this market. Relative strength line looking pretty good. So that's what we talked about this a lot on IBD Live this morning. That typically, you really just need to feel comfortable sitting with a large cash position. You might see stocks that are working like a Quest Diagnostics, some utility, some real estate investment trust. And if you want to take little nibbles here and there, but
Mhm.
raising your invested percentage in names that are holding up well in a down market. Again, we've said it before, we said it again. Weak market tends to go after just about everything. So I'd be careful with stocks showing strength. But again, this is medical services group has been very strong, and Quest is holding support right where it should. So you take a nibble here with a tight stop, maybe see some more gains here.
Next on the list, let's tackle CB. This is Chubb in the insurance space, vying for a breakout from a multi month base here. An uptrend that we've seen for shares, going back to mid to late February, which is right around when the market peaked. And we've seen a number of insurance stocks lead over that time frame.
Yeah, Chubb is a relatively new holding for Warren Buffett. He disclosed a fairly sizable position in this company first half of last year, I believe. And Chubb, you can see, is just right at the top of a lengthy consolidation here. 300 is a round number that looks like an entry here. We've seen a lot of insurers hitting new highs. Again, stable business, consistent demand for the services. So Chubb, if 300 give or take looks like a buy area here. So again, a stock that's working, broad-based strength among all different types of insurers: large cap, mid cap, small cap. But Chubb looks interesting in this market too. Relative strength line with a blue high, and in the early stages of a breakout here. So this is another name that could work in this type of market.
And if traders thought that that industry group ranking for the medical services group was good, well, this insurance industry group is ranked even higher at number 6 out of the 197 groups that we track. So this is looking over a longer time period, but it definitely pays to show which groups are improving in the rankings week by week, because that shows you where the leadership currently is. So if it is these more defensive groups ranked at the top of our industries, as you said, that just gives you a sense of the tone of the market that we're in. Growth stocks, by and large, have fallen out of favor, while these more defensive areas have really bubbled to the top of our screens.
Yeah, most definitely. And mentioned that earnings mentioned that J.P. Morgan and Wells Fargo are going to kick off first quarter earnings season at the end of next week. But the following week, early in the week, we're going to hear from Travelers and Progressive, two two competitors here to Chubb, also in the property casualty title industry group, and yeah, these are both mega caps. They both report early Wednesday, so these will be again two big names kicking off Q1 earnings season, and we'll see if this price strength has been justified, because the way a lot of these insurers are trading, people are optimistic that growth should be pretty good
Mhm.
going forward.
And EHC is the last ticker on our list that we want to look at. This is also in the medical sector, but in the outpatient home care group. We're seeing a relative strength line at new highs for this stock here as well, Ken.
Yeah, their focus is inpatient rehab hospitals. They focus a lot on people with neurological and orthopedic issues. But again, just like totally different industry group than Quest Diagnostics. But again, in the medical sector, where they have very steady demand for their services. People needing rehab services. It's just a constant strong demand. You can see that in the bottom line and top line growth for several quarters in a row. Growth is expected to slow a little bit, maybe because comparisons are getting a little more difficult. But again, just another flight to safety name here, sitting at the top of a base, showing relative strength. So we want to pay attention to the stocks that are working, even when we're in a bad market, and we're not going to be aggressively buying names like this,
Yeah.
but if you want to put a couple of feeler buys out there and increase your exposure ever so slightly, you want to look at names where the money is flowing, not the beaten down stuff that looks like
Mhm.
it's on sale.
Right. Absolutely. I've got to say, Ken, I'm not really tempted at all at this very moment to make any new buys, just because of the market action that we saw today. Maybe we get some stabilization around current levels. We did see the VIX pop a little bit today. I guess that's one last thing we bonus on a key day like today to take a look at. So that fear gauge spiking, but honestly, not quite yet to levels where it could go. In the 48 to the 50 levels, we're right around 30 at this point.
Yeah, I didn't look at also the put call volume ratio is another indicator that measures fear in the market, and this has really not been near extreme levels. I mean, when we see readings up around 1.1.2, 1.25, this is really indicative of a fearful market. And when you've got excessive fear in the market, that
Mhm.
tends to be when bottoms are put in. But at least in
Right.
terms of the put call volume ratio, not seeing a lot of fear in the market, at least, not yet.
Yeah. All right. Well, we'll be keeping an eye on the different secondary psychological indicators out there, as well as what the major indexes are doing and leading stocks. So we'll have to leave it there for today. But thanks, Ken, as always. We appreciate it.
All right, take care.
Take care. And that is it from us for today, but we will be back with more tomorrow morning on IABD Live to wrap up the week with former U.S. Investing Championship winner, George Kachuk. So he really focuses on biotech names, and we've actually seen a lot of interesting action in the biotech space in addition to the broader medical sector. So it'll be interesting to get his take on what he's seeing out there. So tune in tomorrow morning on IBD Live, investors.com/IBD Live for all the details starting 10 minutes before the opening bell. We'll see you all there. And then Mike Webster and I will see you right back here tomorrow after the close to wrap up the week. We'll see you then, everyone.